Recently, there's been a lot of buzz about Ethiopia's GDP dropping from $207 billion to $100 billion. But what does this really mean, and why are people concerned? First, let's understand GDP. GDP, or gross domestic product, is the total value of goods and services a country produces in a year. It's like the country's financial report card. It shows the size and health of its economy. So, why did Ethiopia's GDP suddenly drop? It's not because the economy stopped producing goods and services, it's because of currency devaluation. In 2016, Ethiopia shifted to a market-based exchange rate system, which caused the Ethiopian birr to lose value against the US dollar. Here's the key. GDP in Ethiopian birr didn't change much. But since GDP is often measured in dollars for global comparisons, the weaker birr made Ethiopia's GDP appear smaller when converted into dollars, from 207 billion to 100 billion. This also affects Ethiopia's public debt. Imagine you owe $1,000 and your currency loses half its value. Paying back that debt suddenly feels twice as hard. That's what happened here. Ethiopia's debt-to-GDP ratio increased because the weaker birr reduced GDP's dollar value, even though the actual debt didn't grow as much. No? The government adopted this exchange rate reform to attract foreign investment and boost economic growth in the long term. But in the short term, it led to challenges like higher import costs and a heavier debt burden. While Ethiopia's GDP in dollars dropped, it doesn't mean the economy stopped working. It's about how the numbers are calculated. Understanding this helps us focus on long-term solutions to strengthen the economy.